Generally, finance is the study of banking, leverage, credit, capital markets, money, and investments, along with how they are used by individuals and companies. Many of the basic concepts in finance come from micro and macroeconomic theories. One of the most fundamental theories is the time value of money, which essentially states that a dollar today is worth more than a dollar in the future. Finance is often segmented into public, private, and corporate finance. The public finance sector includes government tax, spending, budgeting, and debt issuance policies that all affect how a government pays for the services it provides to the public. Corporate finance refers to the financial activities related to running a corporation. Personal finance applies to individual consumers and the ways they manage their spending, save for the future, and pay for basic needs. These three categories contain many subcategories, including behavioral finance, intangible finance, experimental finance, and financial mathematics. In addition, finance is often used as a general term to refer to borrowing money on credit to pay for something. For instance, if Dane needs to buy a new bathroom sink for his home remodel, but does not have enough money to pay for it, he may use the buy now, pay later credit offer from a large retailer to finance his purchase.
Hello, everybody. This is Professor Hassey. It's our week #1 lecture video for the week of June 5th to June 11th. Today is Tuesday, June 6th, and I welcome you all to the Business Finance 330 class for this summer. At the beginning of this video, I gave you a brief video about defining finance, and we'll be doing a little bit of that this week and next, looking at financial statements and the definition of finance these first couple of weeks. Our class is designed to give the business administration student a background in what is finance, financial statement analysis, capital markets, stocks, bonds, and the time value of money in capital budgeting. So that's the topics we'll be covering over these next 8 weeks. This is an online asynchronous course, meaning there's no classroom meetings. Everything is done through video and the Blackboard platform. So I welcome you all, and we're off to a good summer, I hope, in the study of finance. I hope you've had the opportunity to look over our Blackboard and begin our work for this week. Again, every week I have an agenda. I have the files and videos posted in Blackboard. It's your job as a student to review these files, and then with our video on the weekend, at our end of the week video every week, we'll review problems and use applications of the topics that we're looking at for that particular week. This week mainly is a nice, easy, slow start. We're just taking a look at the definition of finance, have the students get familiar with this course on Blackboard, do a discussion forum posting to tell us a little bit about yourself, your biography, and also put together a portfolio of stocks. And I'll talk about that in just a minute. This week #1 is entitled Overview of Markets and an Introduction to Finance. You have one graded post. We'll look at some of these problems in review on our weekend video. We're talking about chapters 1 and chapters 2 in the text, a definition of what a corporation and financial markets are. In our Blackboard, you have a variety of videos. This is my course introduction video, but a variety of videos and explanations of the material. Here's our key topics of chapter 1 with a PowerPoint of that chapter. The same thing holds true for chapter 2, the definition of finance, and another PowerPoint. So if you're not into reading the text much, those PowerPoints are good reviews of the material in each text. Also, I have review problems, and I have in the in-class notes and review a PowerPoint, which will be my lecture this evening, and an example or a PDF of how I would like your portfolio to look like this week, and I'll go over that in just a minute. So every week you have a week folder of all the materials for the class. And if you have any questions or concerns, remember we have student hours every Thursday evening from 6 to 8. But feel free to contact me at any time if you have any issues or concerns with the class. Next week, we will have student meetings with your professor, me. I'll put a schedule out at this coming weekend where you can pick a day and time to come online in Zoom and meet with me for about 10 minutes just to get to know me. I can get to know you and talk a little bit about the course and where we're headed. So I appreciate that. And that's where the bios that you're doing this week will help me. I'll get to know you a little bit better. And so I'll be a little bit more prepared when we meet individually next week. Remember, in the discussion forum this week, I have a couple of tasks for you to do. First of all, it gives me a little bit of background and assessment on your abilities of using Blackboard. So you will create a forum and give me a little example of a biography about yourself. Tell us a little about yourself. And then part 2 will be putting together a stock portfolio of $100,000 as of the value of your stock as of the close of the markets this Friday, June 9th. So remember, the United States stock markets here in California close at 1 p.m. every Friday or every day. So after 1 p.m., you can go and look up the stock prices that you have selected, and I'll talk about that and how to do that in just a little bit. Here's an example of the portfolio, and let's take a look at that sample now. The portfolio is designed for a class-long project. We're going to be doing this over the 8 weeks and have various discussions about it over the course of our class. But you are to pick your companies this week. You can pick 1, 2, 3, 4, 5 stocks. I picked 4. This is my portfolio for this summer. And it has to be publicly traded stocks on the American stock exchanges, meaning New York Stock Exchange and the NASDAQ. If you want definitions of those stock exchanges, you can go to our Blackboard in the early weeks of our class and see definitions of the S&P 500 and the New York Stock Exchange and so on. So those are part of our Blackboard presentations. This portfolio is to be totaling $100,000. So you have $100,000 to invest in your companies. I want you to do a couple of things. First of all, this is a PDF version, but I want you to set this up in a spreadsheet. I want to see you post a spreadsheet file to the Blackboard. So again, notice I have Apple, Best Buy, NVIDIA, and Walt Disney Company, the ticker symbol representing that company, the exchange that it's traded on, the purchase date of June 9th, and then what I've done is I've allocated $25,000 to each stock. Now remember, this has to total $100,000. So how do I make that total $100,000? Well, it's very simple. In your spreadsheet, you will find the price of the stock on June 9th. In this case, Apple is $163.62, even though it's not June 9th yet. And then I would take that $163.62 and divide it into $25,000. So if this was a cell in Excel, you would see this being divided into this cell to get 153 shares of stock. And I rounded that to the nearest whole number. I don't want to see decimals in shares. So in other words, in your spreadsheet, I want to see a formula in the share column, taking the price, dividing it into the allocation of money, and then you get your amount of shares. So then you have exactly the amount of the investment. That determines or drives the amount of shares that you purchase. Then as we go forward into the class, as the price changes over time, you'll take that change in price times the number of shares you purchased on June 9th to get your up-to-date valuation of your 100,000. Clear as mud, huh? But I want you to put that into a spreadsheet. So don't give me a PDF file. Give me a spreadsheet file so I can see your calculations of your shares. But set it up just like this. Another thing you're going to be doing is tracking the 3 leading indicators of the market: the Dow Jones Industrial 500, the Dow Jones Industrial Index, the S&P 500 Index, and the NASDAQ indexes. Again, these are defined in Blackboard, and these indexes are the market indicators. Top 30 companies according to the Wall Street Journal, the top 500 companies according to the S&P 500, and the top 25 small and mid-sized companies according to the NASDAQ exchange. So we're going to be tracking the market returns versus your returns during the course of our class. And why we are doing this? Because it's a good practice and a good way of understanding the markets, a key topic of our business finance class. And secondly, it's kind of fun to see what students make money over the next 8 weeks. Who's going to have the greatest gain on their stock portfolio? And whoever that is will become the Wolf of Wall Street. And you'll get a little prize at the end of our course for the student who has the best performing portfolio. And looking at my portfolio now, I have a very good idea that I will not have a very good performing portfolio, especially owning Disney and Best Buy right now. But we'll talk more about that later. So that's the portfolio you'll be doing over the next course, like over the next 8 weeks of our course, and more specifically for a grade this week as of June 9th in a spreadsheet file. I want to see you create the spreadsheet with this format. One of the easiest ways of looking up stock used with the internet is Yahoo Finance. Google Finance is also a good way, but Yahoo Finance is pretty user-friendly and a neat, quick little way of determining your stock prices. So let's say it's June 9th, Friday, the markets have closed. It's the afternoon of Friday or even Saturday. I can go into Yahoo Finance. Remember, one of my company stocks was Disney. If I type in the search Walt Disney, there is the Disney company with its ticker symbol right at the top of the list. I click on that, and up will come the closing price of the stock for that day. Disney closed today, this is Tuesday, June 5th, at $92.16. So that would be my closing price of that day. All right. And you can do that for all your companies. For example, if I type in Apple, there's Apple Incorporated, AAPL is the ticker, and here's the price of Apple on this day. And you can do the same thing for the S&P, the Dow, the NASDAQ, to give you the current prices at the market close on Friday. So you'll put those prices down. Also, during the course of our class, we'll be doing a lot of work concerning some of this information here about the companies and learning about the financial markets. And this will be a good way of practicing that and getting to know it. Now, maybe some of you already dabble in the investment markets and know a little bit more about this. That's fine. So you can dazzle us with your expertise in picking and analyzing your stock portfolio. So that's how you go about finding the stock prices. Yahoo Finance is a very easy way of doing it. So you'll create a forum in the discussion forum and create a form in your name and post our biography, then create a form, or you can even use it on the same form if you'd like. Part 2, pick your portfolio, explain to me in 1 or 2 sentences why you picked those companies in your portfolio, and then attach and insert the spreadsheet file into that Blackboard file folder, and then I can review it and make sure that you've got it all set up for the year or the semester ahead. So that's your assignment for this week, and it's 10% of your course grade due Sunday, June 11th. If you have any questions or concerns about this, remember our student hours are Thursday evening, 6 to 8, if you have any issues or questions or concerns. Our class is business finance, and as part of your business administration studies, it's very important to understand where company obtains their money, their capital. How do they go about borrowing it, issuing stock or equity? Where does that money come from? What are the markets that we use to get that capital? It's a very important part of business. A company cannot have any accounting. A company cannot have any marketing or distributions or manufacturing unless they have the capital to do that. That's why it can be a big headache trying to balance and trying to find money, especially in markets like today, where it's high inflation, a lot of uncertainty in the markets. That can make it very difficult for a company's CEO and CFO to function as a efficient business. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision-making if the corporation is to maximize profits and stay competitive for future success. That's a fancy way of saying, where do we get our money? And we have a series of disciplines. Capital budgeting is to determine whether a return on investment is worth the investment of capital. Capital structure is how you fund capital projects, how you develop the resources for your business by either, remember, there's 3 legal ways a company can acquire capital. You can borrow it, you can issue equity, be it private equity like hedge funds or capital financing through venture capital funds, or public equity, issuance of stock. Debt, equity, and the third way is to make a profit. Make a profit. And those profits are reinvested back into the company to finance your capital needs. That's the capital structure. And working capital is the day-to-day capital management of your business, which can be quite different than the long-term needs of your business. Long-term capital is investing in assets, equipment, buildings, land. Short-term or working capital is just making sure you have enough cash flow to pay your bills. It's kind of like your own personal finance. Many of us get paid or get a paycheck twice a month. Those paychecks are used to pay our expenses. Without those paychecks, we would be in trouble. And then on the odd occasion, when our paychecks are not enough to meet our cash needs, we use a credit card. The downside of that, though, is eventually we're going to have to pay it back. Well, that's working capital management and just a little bit more accelerated for a corporation. This is what corporate finance is all about. There are 3 key principles or strategic principles of corporate finance. The investment principle. Every investment must earn a return greater than the cost of that investment. And the cost of that investment has many headings. In this case, hurdle rate. I'll give you an example. We go to a bank and we borrow money at 6%. We take that money at 6% and invest in an asset. That asset hopefully will have a return greater than 6%, so we can pay off that borrowing of money and make a little bit extra as a return on that investment. That's earning a return over the cost of the money, which is also defined as the hurdle rate. Another name for the cost of money is the weighted average cost of capital, which is one of the key concepts we'll talk about in this class later on. The second principle is the financing decision. Where are you going to get the capital to and make that investment in an asset? A mix of debt and equity is the usual way to go, especially for corporations. Corporations have a lot of credit, so they can get cheap money usually in the debt market, but also they can go out and get some reasonable money by issuing stock. Whereas you and I, because we don't have much equity or leverage, we have to pay higher interest rates for our debt, credit cards, mortgages, car loans. So the financing decision and the cost of that financing plays a decision in maximizing the value of the firm. And finally, the dividend decision. How do we allocate the return to the investors who gave us the capital? In terms of stock, it's dividends. In terms of debt, it's interest payments. How do we make those decisions of giving back return on our investments? Those are the three key areas of corporate financial strategy. And we do it in the organization of three different types of organizations of businesses in the world. The sole proprietorship, which is the one owner business, the partnership organization, which has multiple owners, and the corporation, which has many owners, but those owners are not associated with running the company. They have owned stock in the company. Whereas in a sole proprietorship and a partnership, those owners actually run the business. But if you own stock in Apple Computer, you don't run the business. You hire managers to run the business. That's one of the key areas of corporations. Corporations are what we'll be studying mainly in this class because those are the largest businesses in the country. There are many more. If I owned a proprietorship or a partnership, I can be sued directly. And if I'm sued, not only is the business being sued or liable, so are my personal financial responsibilities. Whereas in a corporation, if a corporation gets sued, the shareholders are not liable. If Apple gets sued and I own stock in Apple, I'm not going to be affected. So it's easier to invest in a corporation because there's less liability for the ownership. The liability is solely in the assets of the company. That's called limited liability. That's why so many companies you see today have at the end of their names LLP or limited liability company, because they're sole proprietorships or partnerships, but they are run legally like a corporation. LLP, LLC, those are limited liability businesses that are run as proprietorships, but also are treated as corporations. And why do we need capital? Because in order to compete in the marketplace, we have to grow. If you stay stagnant with your products and your services, there's going to be competitors that are going to kick your butt, especially nowadays in the globalization of our businesses. Competitors in China, India, Europe, Australia, South America, Africa. We have to compete with all those different competitors. Thus, we need capital to better our products, grow our markets, and become efficiently managed businesses. And the need for capital to fund that growth. This is my high-tech slide of this first week. What is management's objective in a corporation? Well, as the top left side slide says, management's primary responsibility is to maximize shareholder profits. And here's a manager of a business jumping up and down, trying to see what does it take to maximize those profits. What does it take to maximize profits? Cheap capital, cheap money, efficiently managed organization, an efficient and well-priced product. That takes capital to achieve all those goals. So what is the primary responsibility of this manager? Well, to maximize profits, but at the same time, there's ethical responsibilities, social responsibilities, community responsibilities. One of the things that I have learned in my career as a financial manager is the most important entity of a business is not so much your customer, but making sure your employees are taken care of, because when they're taken care of, your products and your services will be better. Some companies don't get that. So there's more important items besides just making a profit. Are we paying our people adequate wages? Are we not polluting our community? Are we making ethical decisions? Are we not sleazebag operators? These are very important concerns in addition to making money. I talked earlier about the hurdle rate and the cost of money. This is a key concept in finance. It's called a weighted average cost of capital. We'll be learning how to calculate this in our course, but the key thing is the cheaper your money, the more valuable your firm is. And that's why today, on June 6, 2023, high inflation means assets are worth less. And companies are struggling to bring that inflation rate down, especially in our government, to make our assets more valuable. And then also, we cannot forget about conditions that affect capital, government policies, international trade, the globalization of our economics, political environments, social environments, trade and currency requirements. All these, in addition to our own policies of running our business, affect our company. And these are influenced in the markets that we go out and obtain capital. The primary and secondary markets, the private and public markets. These all are discussed in Chapter 2. The physical location of getting capital, the New York Stock Exchange, the American Stock Exchange, all in New York, the Chicago Board of Trade in Chicago, the various stock exchanges around the world, Tokyo, Beijing, London, Berlin, Rio, Sydney, Australia, all around the world, where companies can find investors by exchanging equity or debt to acquire capital. There it is, the Franklin. Without cash, companies cannot survive. It's the blood of a business. You can have a great business plan, a great business model, but if you don't have the capital, you're out. And to manage that capital is what corporate or business finance is all about. As I don't think I've told you, I was an investment banker for many years before I became a professor. And every day I used to get up and I'd look at these various indicators to tell me what's going on in the world. These are the indicators for the last few years. And here they are right up to date through the end of May. The equity markets, represented by the Dow Jones Industrial Index, the Standard & Poor's 500 Index, which is defined in this week's week number 1 course content. The NASDAQ Index, those are the equity funds of America to keep track of them. The Dow is down about 1% this year. The S&P 500 is up about 9%. And the NASDAQ, thanks to Apple, is up about 24%. Those are the equity markets in America. The next one is the 10-year United States Treasury yield. That is called the risk-free interest rate. The United States government, along with the Chinese government, have the best credit rating in the world. This was tested in the last couple of weeks with our debt ceiling negotiations in Congress, but that passed. President Biden signed it. So we will continue having perfect or A-rated credit. So the United States government, if they need money and they borrow money for 10 years, which is in lots of $1,000, they have to pay roughly $36 on $1,000 of interest. 3.636% is the current rate. It's gone down a little bit since December. And if we look back at last year, notice in December of 21, it was 1.5%. In 2020, it was even below 1%. So it has gone up, and that's inflation. Now, when the US Treasury yield goes up, so do our credit card rates, our mortgage rates, our prime lending rates. And this is what all the hubbub is with the Federal Reserve, to try to keep those interest rates down to encourage borrowing. Sometimes it doesn't work that way. But that's a key rate for anybody in investing or in financial management, is what is happening to interest rates. And the 10-year United States Treasury yield is the benchmark of those rates. Then we have two numbers that are commodities, oil and gold. Notice oil is down about 15% thus far this year, which is good, makes gasoline prices cheaper. Gold is up a little bit by 8%. And usually gold goes up when the economy is not doing so well. Gold is like a hedge fund. People invest in gold when the other markets aren't doing as well. Oil and gold are the two leading commodity markets. And then finally, the currency markets. The relationship of the United States dollar to the euro, to the Chinese yuan, to the Japanese yen. And thus far this year, the dollar is doing pretty well. But the currency markets are important because, as many of you might even have relatives in outside of the United States, and whenever you send money or they send you money, the rates change. It's the supply and demand of currency around the world. And if your company is doing business in many countries, how the currencies change can affect your business dramatically. During the course of our class, you are in your business, in your stock portfolio, will be tracking the Dow, the S&P, and the NASDAQ. But we'll also be talking about these other indicators because they tell us what's going on in the world around us. And that's quite a world. The Chinese yuan. That's our main competitor. Will always be our competitor. Why? They have 3 billion people. They have vast resources. They have a strong military. They have a strong government in control of their country. Same thing in the United States. We have the strongest economies, the strongest military, the strongest in political system, which is up for debate these days, but we'll say that. That's why these currencies dominate the world markets. And if you're doing business you have a company in San Dimas, what happens in China will affect your business. What happens in Europe will affect your business. And understanding that is one of our goals in this course. So that's an introduction to finance. Key indicators tell us where we are in the markets. Understanding the principles of investment return, capital structure, capital management. These are all issues we'll be talking about in this class. So we're off and running. Would I make sure you get a handle on Blackboard this week? Post your discussion forum, work on that portfolio by next Sunday. Get to know our course setup. Remember, whenever I send you or post a video, I will send you an email, which is located in your course announcements. As I post the grades for this class, you'll be able to see those grades in the report card section of your Blackboard. The key thing is to stay engaged for 8 weeks in this online course, and I will help you with that. We'll meet next week individually to talk about the course and answer any questions you might have. If you have any concerns at any time, please let me know. So thanks, everybody. We're off to a start. I'll be talking to you in our end of the week video, looking over some examples of what we talked about here. And I look forward to working with you all. Until later in the week, adios.